So imagine running a nearly flawless business. I mean, you are just sitting on over $13 billion in cash. Your customers basically refuse to leave, and you're growing your top line faster than anyone thought possible for a company of your size.
Right, it sounds like an absolute dream scenario.
Yeah, it does. But here's the crazy part. Wall Street's reaction to all this success, they are actively punishing you.
Which makes no sense on the surface.
Exactly. Welcome to the deep dive. You asked us to look through these latest financial research notes on Costco, ticker symbol COST. And when we dug into the data from late August 2026, we immediately noticed this massive contradiction.
Yeah, it jumps right off the page at you.
It really does.
Yeah.
So our mission today is to unpack this bizarre divergence. Why is a company that seems to be executing, flawlessly, seeing its stock price suddenly derated?
It is quite the paradox, honestly, when you look at it closely.
Yeah.
Because you study the business fundamentals and the research you provided, and they are pristine, just beautiful. But then you look at the stock chart, and it's flashing warning signs.
Yeah, like big red flag.
Right. So to figure out what's really going on, we're going to look under the hood at their recurring fee engine, which is it's their true superpower.
Oh, absolutely.
And we'll also explore a brand new, highly unexpected services lever they are pulling. And most importantly, we have to unpack the mechanics of why the market is suddenly getting cold feet despite all these operational wins.
Okay, so let's lay out the immediate, frankly confusing reality of their current numbers first, because the scale here is, it's difficult to wrap your head around.
It really is.
Over the first 9 months of fiscal 2026, which runs from September 2025 to May 2026, the business didn't just grow, it boomed. We're talking about revenue hitting $207.4 billion.
Wow.
Right? That is an increase of roughly 9.7% from the exact same period last year.
Which is just an astonishing figure when you consider the law of large numbers.
Yeah, explain that for a second.
Well, for a startup to grow 10%, they just need like a few good contracts, right? But for a company of Costco's sheer gargantuan size to move the needle almost 10% on the top line, that requires a massive influx of foot traffic and volume. I mean, they aren't just capturing new dollars.
Yeah.
They are actively taking market share away from their competitors in a highly saturated retail environment.
And it gets even better when you look further down the income statement. Like, their net income actually grew faster than their revenue.
Which is always what you want to see.
Exactly. It jumped about 13.5% to hit $6.2 billion, and operating cash flow is up 17.6%.
That's huge.
It is. They are sitting on a fortress of a balance sheet with a net cash position of roughly $13.28 billion.
Just an incredible amount of cash.
Yeah, and if you are wondering if they just had a really good winter and spring, July sales continued the exact same momentum, up 10.7%. The business is basically a juggernaut right now.
Yeah, by every single operational and financial metric provided in the source material, the underlying business is accelerating. They're generating more cash, selling more goods, and actually widening their margins slightly through operational efficiency.
So if you are holding these notes at home, you are probably thinking, great, the company's printing money, I'll go buy the stock. But here is the massive disconnect we mentioned.
Right, the stock chart.
Yeah. The stock is down nearly 12% over a 13-week period. It is sitting around $947 right now, which is almost 14% below its 52-week high.
Yeah.
So why punish a winner? Like, are investors just deciding that bulk toilet paper and rotisserie chickens aren't a compelling narrative anymore?
Well, the drop has absolutely nothing to do with the business failing. And it has everything to do with what you actually have to pay to own a piece of it.
Okay.
The pullback is fundamentally about valuation concerns colliding with a weakening macroeconomic consumer backdrop. Independent analysis in your notes is actually described Costco's stock as being almost too good.
Yeah, I saw that phrase and I literally had to read it twice. How on earth can a stock be almost too good?
It sounds weird, right? But it means the quality of the company is undisputed. Everyone agrees Costco is a phenomenal business with excellent management. But because everyone knows it, the stock price has been bid up to a massive premium by investors who are just seeking a safe haven.
Oh, I see.
Yeah, and when you are priced at a premium, the market leaves you absolutely zero room for error. If the broader consumer environment weakens even slightly, maybe inflation ticks up or consumer spending slows down, investors start to wonder if that premium price is still justified.
So they get spooked.
Exactly. They start selling off out of fear, even if the underlying company is still performing perfectly.
That makes sense. We all know you have to pay a fee to get in the door at Costco, but what these research notes reveal is just how heavily the entire financial survival of the company rests on that specific metric.
It is the whole ball game.
Yeah, to understand if that premium price tag is actually justified, we really have to look closely at the mechanics of how they actually make their money.
Because the surface narrative is that they are a retailer, right?
Right.
But their core economic engine operates on a completely different paradigm.
Totally different. When you look at their trailing 12-month or TTM gross margin, it is just 12.88%.
Which is low.
Very low. And their net margin, a microscopic 3.01%.
Wow.
Yeah. I mean, for every $100 you spend in that warehouse, they're keeping barely $3 as pure profit.
That's incredibly thin.
If you tried to run a normal retail business on those margins, one bad quarter of unsold inventory would literally bankrupt you.
Oh, without a doubt. It
Yeah.
is the classic high-volume, razor-thin margin model.
Right.
But it is inherently fragile on its own.
Right.
The only reason it works, the only reason Costco can survive making just $3 on a $100 basket is because of the hidden engine.
The membership fee.
Exactly, the membership fee.
And the data shows a staggering 92.2% membership renewal rate. People simply do not give up their Costco cards.
No, they don't. And think about the psychology and the economics of that for a moment. When a member pays that $60 or $120 up front, it goes straight to the bottom line.
Right.
It is virtually a 100% margin revenue stream. But more importantly, it creates this sunk cost loyalty. The consumer thinks, I already paid for the membership. I need to buy everything I can from Costco to make my money back.
That's so true. It's less like a traditional retailer and more like a wildly successful streaming subscription.
Well, that's a good way to put it.
Yeah, like where you just happen to walk through a physical warehouse to get your content.
Yeah.
You pay the annual fee just to have access to the show, which in this case is, bulk groceries, cheap gas, and a giant flat screen TV.
That analogy perfectly highlights the predictability of their revenue. This annuity-like income stream from those membership fees acts as a massive financial shock absorber.
Because of the thin margins on the physical stuff.
Exactly. If you are operating on a 3% net margin, any tiny fluctuation in the supply chain, say the price of diesel fuel spikes, raising shipping costs, that could theoretically wipe out your profit on the merchandise.
Yeah, in an instant.
But that massive, predictable pool of fee income stabilizes their earnings. It reduces volatility and actually allows Costco to aggressively price their merchandise below competitors, knowing the profit is already secured by the fee.
That is brilliant. And looking at the data, that cash flow is also funding their growth. We see they spent over $4.2 billion in capital expenditures over those 9 months.
Yeah, that's a big number.
It is. That is a 19.7% increase in CapEx.
That is a crucial point for you to understand when evaluating their business quality.
Yeah.
CapEx, or capital expenditures, is basically the money they spend on building new physical warehouses and expanding their logistics network.
Right.
And they are funding this massive expansion entirely through their own operating cash flow.
Meaning they aren't going to banks and taking out massive loans with high interest rates to build a new store.
Precisely. And in a retail environment where many companies are leveraged to the hilt, meaning a huge portion of their revenue just goes toward paying interest on their debt, self-funded expansion is a massive competitive moat.
Right, because every dollar they make from a new warehouse goes back into the business, not to a bank.
Exactly.
We also see this translating to their digital strategy. The research notes their digital comparable sales growth hit an impressive 21.5%.
Which is really strong.
Yeah, they aren't just a physical warehouse anymore. They are successfully extending that trust and that massive logistics network online.
Which is vital, for defending their market share against massive e-commerce competitors. It proves their model, the curated selection, the low prices, the membership trust. It translates effectively to the digital space.
So they are self-funding massive physical expansions without debt, and their digital footprint is growing at over 20%.
Yeah.
But to keep growing without borrowing, and to justify the massive stock premium we discussed earlier, they need to find high-margin revenue from somewhere else, which explains this incredibly surprising pivot we found in the note.
Yeah, it is a fascinating strategic leap.
Truly. So, Costco is partnering with the Scan Group to roll out Costco-branded Medicare Advantage and supplement plans in select states.
Let that sink in.
I know, right?
Hmm.
Going from a massive pack of paper towels and cheap hot dogs straight into the highly regulated, highly complex world of healthcare services.
It sounds crazy, But if we look at the mechanics of this move, it actually makes perfect sense for their long-term growth.
How so?
Well, think about how Costco currently makes money from its customer base. They monetize loyalty twice, right?
Okay.
First, they get you to buy merchandise, which they sell to you at deliberately thin margins to keep you coming back. Second, they charge you that high-margin membership fee for the privilege of shopping there.
Right. So this move into healthcare attempts to add a third layer.
Exactly. It adds a layer of recurring, relationship-deepening services income. You have to remember the fundamental difference between selling goods and selling services.
The margins.
Yes, the margins. Selling a television involves factories, international shipping containers, warehouse space, and, inventory shrinkage if the TV gets damaged.
Lots of overhead.
Tons of overhead. Selling a healthcare service bypasses all of that physical friction. Healthcare services inherently carry a margin profile that is far, far above selling physical merchandise.
Plus, the demographic tailwinds are just huge. I mean, you have an aging population that already implicitly trusts the Costco brand to curate the best quality products for the lowest price.
Right.
If they extend that trust to picking a Medicare plan, the lock-in is absolute. If you get your actual healthcare through Costco, you are never letting that 92.2% renewal rate slip. You are basically a member for life.
It really transforms the membership card from a retail perk into a fundamental pillar of someone's personal well-being.
That's a huge shift.
It is. It is what analysts in your notes call an emerging optionality. It pushes the franchise far beyond warehouse retail. However, it is vital to point out that this is currently unproven territory.
Yeah, we don't really have the dollar figures on this yet.
No, we don't. The research strictly notes that while the SCAN partnership's existence is a confirmed fact, any claim that healthcare will become a material profit contributor is currently unquantified and speculative.
Right, so it's early days.
Very early. It is a brilliant long-term upside driver, but it is not what is paying the bills today.
Okay, so let's pivot and look at the dark side of these notes. We know the company is generating massive cash, the membership model is seemingly unbreakable, and they have this huge healthcare upside.
Right.
So why exactly is the stock dropping right now? What are the thesis breakers?
Well, this brings us back to the most critical risk in the entire analysis, valuation risk.
Okay.
We mentioned the premium price earlier, but let's put the actual math to it. Costco is trading at roughly 48 times its trailing 12-month earnings.
Wow. So you're paying $48 today for every $1 of profit they made over the last year.
Exactly. It's an incredibly steep price. Furthermore, the notes indicate it is trading at 12.73 times its book value.
Okay, wait. For the listener who doesn't live on Wall Street, book value is basically what the company would be worth if they shut down tomorrow, sold off every physical warehouse, every pallet of merchandise, paid off all their debts, and just counted the cash left over.
Right. That's exactly right.
So people are paying almost 13 times that baseline physical value of the company.
Yeah, that is a perfect explanation. And when a company trades at 48 times earnings and nearly 13 times book value, expectations are quite literally priced for perfection.
Meaning you can't just be good.
Right. You aren't just expected to do well. You are expected to be flawless quarter after quarter. And the market is looking at potential macroeconomic headwinds gathering on a horizon, and they're wondering if flawless is mechanically possible for much longer.
The research explicitly flags macro risks like tariffs, wage hikes, healthcare cost inflation, and foreign exchange volatility.
All very real threats.
And looking at their margins, this seems incredibly dangerous. It's like balancing a massive boulder on a tiny needle.
I like that.
The boulder is their stock price and that 48 times multiple, and the needle is their 3% profit margin.
Yeah.
The math is holding up right now, but if a gust of wind hits that boulder, the whole thing comes crashing down.
That analogy captures the vulnerability perfectly. This is what the analysts mean by a lack of absorption capacity. When your gross margin is only 12.88%, you have almost no buffer to absorb a sudden spike in input costs.
Let's play out a scenario based on the notes. Say a new broad tariff is placed on imported goods, or international container shipping costs skyrocket again.
Which is totally possible.
Right. Costco's costs go up immediately, and they are faced with a brutal choice. They either raise prices and pass the cost to the consumer, which risks destroying their reputation as the absolute lowest price leader.
Right, their whole brand identity.
Exactly.
Yeah.
Or they eat the cost to protect the consumer, and that 3% net margin just vanishes.
And if they choose to eat the cost or rely on margin dilutive discounting just to keep those monthly top-line sales numbers looking good, Well, Wall Street's algorithms will see the profit compression instantly.
Right.
If that happens, or if that sacred 92.2% renewal rate slips even a fraction of a percent because households are feeling economic pressure, the stock faces severe multiple compression.
Okay, let's clarify multiple compression for the listener because it's a huge factor here.
That's right.
It means the market decides the company is no longer a flawless diamond worth 48 times earnings, but maybe a slightly flawed diamond only worth 30 times earnings.
Exactly.
The business could still be churning out billions in cash. Nothing about the physical warehouse has changed, but the stock price tumbles simply because investors refuse to pay the premium anymore.
It is the brutal math of high expectations.
Yeah.
It's also worth noting the sentiment from the executives inside the company right now.
Oh, right, the insider trading data.
Yeah, the insider tape we reviewed is showing a slightly negative lean. There have been 0 open market purchases by insiders recently.
0.
0. And 1 open market sale of 885 shares.
I mean, it's sparse data, certainly not a mass exodus.
No, not at all.
But it doesn't scream that the people running the company think their own stock is currently a bargain.
Right. It's a data point to consider.
Okay, so we've laid out the incredible upside. The self-funded expansion, the digital flywheel, the strategic pivot into Medicare.
Yeah.
And we've detailed the very real downside. The razor-thin margins exposed to tariffs and a stock priced for absolute mathematical perfection. What are the actual events coming up that will force the market's hand one way or the other?
Well, the ultimate decisive near-term test is going to be the fiscal Q4 2026 earnings report.
Okay.
That's scheduled for September 24th, 2026.
Because that report is the proving ground for everything we just discussed, right?
Exactly. It will confirm if the operating leverage we saw in the first 9 months, where profit grew faster than sales, is actually durable in this shifting economy.
Right. They have to prove it wasn't just a fluke.
Yeah, it will prove whether they can sustain that roughly 10% top-line growth while keeping those razor-thin margins completely stable, despite all the macro pressures creeping in.
So if they post a good number,
If they print a clean report with stable margins, it validates the 48 times multiple, at least for now. But if they miss, that valuation becomes a massive liability.
right?
This is why the overall analytical stance on the stock in your notes is currently labeled neutral. But specifically, they say, constructively positioned.
Meaning the business fundamentals are incredibly strong, but the sky-high valuation limits any immediate reward until that September 24th report clears the air.
Exactly. They have to prove they can handle the macro headwinds first.
But let's look past September. Let's look out 2 to 5 years. The research outlines this blue sky scenario. And just to be clear to the listener, this isn't a prediction, but a look at what happens if all these evidence-supported growth drivers actually align perfectly.
Right. In this highly optimistic scenario, several things happen simultaneously. The physical merchandise sales continue to grow at a steady 9 to 10%.
Okay.
The digital comparable sales sustain that massive 20% growth rate. The membership renewals hold steady above 92%. And crucially, the Scan Medicare partnership proves successful and expands geographically across the country.
If that chain of conditions actually plays out, the entire market narrative around the company has to shift, right? I mean, investors would stop valuing Costco as an expensive retailer, constantly struggling with 12% gross margin.
Precisely. They would start valuing it as a recurring revenue services platform.
Which is a whole different ballgame.
Entirely different. They would see a business where a significantly larger slice of the overall profit comes from high-margin membership fees and an emerging healthcare services layer. The retail warehouses simply become the physical customer acquisition engine for the real moneymaker, which is the services.
That is wild to think about. If they pull that off and they convince Wall Street they are fundamentally a services platform, earnings could theoretically outrun any of the current valuation concerns.
Absolutely.
Because a recurring revenue services business historically commands a much higher multiple than a warehouse selling bulk consumer goods, right?
Oh, yeah. The cash flow is stickier, and the margins are vastly superior. The lock-in becomes absolute.
So that is the blue sky upside that is likely not fully priced into the stock, even at current level.
Right, because it requires flawless execution on a very, very ambitious pivot.
Okay, to summarize this whole journey we've been on today through these notes, Costco is essentially a masterclass in business quality. You have a fortress balance sheet, self-funded expansion, incredibly loyal members paying upfront for the privilege to shop there, and exciting new growth vectors in digital and healthcare.
It's an amazing list of strengths.
It is, but all of that operational excellence is currently colliding with the harsh reality of sky-high market expectations and very real macroeconomic risks on a business with 3% net margins.
Yeah, it is the ultimate reminder for anyone analyzing the markets. A great company and a great stock price are two entirely different concepts.
Very well said.
Right now, the business execution and the market valuation are having a severe disagreement.
They really are. It's going to be fascinating to see how the market reacts when the truth comes out on September 24th. But I want to leave you with a final thought to mull over, building on the mechanics of that incredibly surprising Scan Group partnership.
Okay.
We've talked extensively about how Costco monetizes loyalty and how moving into Medicare adds a high-margin services layer.
Right, but it requires a massive leap in consumer trust to work.
Exactly. Trust is the operative word. If Costco successfully integrates Medicare and healthcare into its ecosystem, if they prove that their members will trust them not just to curate their grocery budget or fix their tires, but to manage their actual physical well-being,
Yeah.
what other major complex life services could they bundle into a simple annual membership? Right. If they secure that level of absolute unquestioned trust, could we eventually see Costco auto insurance, Costco mortgages, Costco wealth management? Where does the concept of the everything warehouse actually end?